Stock market corrections, also known as crashes, are often thought of as an investor's worst nightmare. However, with a little education and a solid investment plan, they don't have to be. Crashes can happen in any of the markets a portfolio is invested in. But in this lesson, we'll focus on equity markets only. Weathering a market correction is just like weathering a bad storm. When a big storm is forecasted in your area, you might do the following. Before the storm, take precautions to protect yourself and your possessions. During the storm, seek shelter. After the storm, rebuild or repair any damage that was done. And most importantly, learn from any mistakes along the way. The same goes for managing an investment portfolio. Before a market correction, an investor might create a personalized investment plan, assess their stock portfolio sensitivity to the market, and adjust their portfolio so the sensitivity aligns to their risk tolerance. During a market correction, an investor might adjust their portfolio again if necessary and use strategies that are typically profitable when the stock market falls. And after a market correction, an investor might adjust their portfolio back to where it was before the correction, if that still makes sense, of course, and add more money to their portfolio if possible. Let's explore each step. Step 1. Create a personalized investment plan. This will come as no surprise if you've watched any of our other lessons on portfolio management. Creating an investment plan leads investors to deliberately think about their goals and risk tolerance. An investor's risk tolerance is pivotal in determining the makeup of the portfolio, from asset allocation down to individual positions. That leads us to step 2. Assess your stock portfolio's sensitivity to the market. A stock market correction usually has the biggest impact on the equity portion of a portfolio. Some investors prepare for a correction by selling some of their equities and buying other asset classes, like fixed income, cash equivalents, or other non-traditional investments. This is called reallocating capital. Other investors may want to remain involved in the equity market. This is because, historically, some equities have outperformed the market during a pullback, while others underperformed. Thankfully, someone came up with a formula to explain that relationship. Allow me to introduce you to beta. No, not my beta fish, the mathematical calculation. Now, I'm not going to break down the formula. That's beyond the scope of this lesson. Just know that the beta measures how a security behaved in the past when the market moved in a certain direction. It helps investors gauge how a stock might move in relation to the overall index it tracks, or even the overall market. Positions with a beta greater than 1 are expected to outperform during times when the broader market rises. However, they're also expected to underperform the market when times get tough. And the opposite applies too. Positions with a beta less than 1 have outperformed markets during a downturn. These are typically referred to as defensive stocks. However, keep in mind that the opposite is true when the markets are moving upward. Identifying the beta of a position is made easy on WebBroker. For stocks, just call up the ticker you'd like to view and click on the Overview tab. You'll see the beta score along with the stock's financial metrics on the right side of the screen. For mutual funds and ETFs, call up the ticker and select the Performance and Risk tab. Generally speaking, if an investor is uncomfortable with the beta of their equity portion of their portfolio, then it might be time to move to this next phase. Step 3. Adjust the portfolio. Portfolio adjustments generally involve transaction costs, so it's best to only make them when necessary. And adjusting a portfolio to bring risk in line with an investor's comfort level definitely applies. A common way to help lower a portfolio's risk is to sell equities and either keep the cash or buy fixed income products. Another way is to lower the beta of equities in the portfolio by selling the positions that have a high beta and buying defensive positions that have a low beta. Remember, new positions can be stocks, mutual funds, or ETFs. Once we've prepared our portfolios for the upcoming storm, we wait to see if it hits, and whether it does or doesn't, on to step 4. Adjust the portfolio again if necessary. A meteorologist is never 100% accurate, and neither are market forecasts. For example, let's say analysts firmly expect a major market correction is on the horizon, and an investor believes their portfolio's risk is still too high. They may consider decreasing the percentage of their portfolio invested in equities or lower the average beta of all those equity positions. And what if a correction does occur, but it's smaller than expected? In that case, an investor may want to increase the percentage of their portfolio invested in equities, or increase the average beta of their equity positions. Now for step 5. Use strategies that are typically profitable when the stock market falls. A word of warning about this one. These strategies are best left to more experienced investors because they can be complex and carry additional risks. For this reason, I won't be diving into each strategy, but some of them include shorting stocks, trading inverse ETFs, and trading certain option strategies. Once the market crash is over and recovery is underway, it's time for step 6. Adjust the portfolio back to where it was before the correction, if that still makes sense. This part is straightforward. It involves reversing the adjustments made to the portfolio in preparation for the market crash. Investors may also implement step 7 at this point. Add more money to their portfolio if possible. Historically, market crashes have lowered the stock prices of many companies to the point where many have considered them bargains, or, in financial industry terms, undervalued. This may present investors with an opportunity to buy the dip. In these scenarios, investors have scooped up assets at a relative discount to potentially enjoy better returns if the markets were to recover to their levels before the crash. Theoretically, this would make their portfolios even more valuable than where they were before the pullback occurred. And that hopeful note brings us to the end of our list of survival tips during a market correction. Remember, just like bad storms, market crashes can be unpredictable and sometimes scary, but historically, they haven't lasted forever. The sun will eventually shine one day. So with a solid plan and some preparation, investors can have the tools to not only weather a stock market downturn, but possibly capitalize from one too.